Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And if you layer it on to your longer-term trend analysis in your technicals, fairly straightforward technical analysis, then they start to validate one another. And that's when you know you start to have a fairly good trade set up, when the fundamental analysis you start to do is validated with your basic technical analysis. That increases the probability that you're going to have a good trade, and that's how you use the two together. Very straightforward, very simple. And again, if you step back on an intermediate term basis and use the ISE FX options product really as your asset class to make this trade, that's why it's a great product for this. It's not that you're always going to know or predict the future, but if you get it right and you buy yourself time to allow these moves to play out, and you buy an FX option, a put or a call, fairly early in this move, again, you don't have to buy it at the bottom, but you're buying yourself time to let this money flow play out on your fundamental view. And that's exactly how we use them and why we like them so much. Remember, as you're going through your reading, you're just thinking about rationales. As you're doing that daily reading, you're thinking about what does the market expect? What's the consensus? And also keep in mind what the market expects and the market knows is already in the price. People get all excited sometimes. They come up to me when I'm doing some seminars and they say, Jack, the dollar's going to fall because of A, B, C, D, and E. And I think to myself, and sometimes I'll say, look, you know that, and I know that, therefore other people know that, so it's already in the price. So keep that in mind. Don't get too excited about what everybody knows, but be very excited that you have a good grasp of what everybody knows, and start to develop those alternative views. Again, you're trying to think of those alternative views that sooner or later will be validated in price action. Your plausible alternative view should not already be in the price, obviously. Your plausible alternative view is that idea that's going to allow you to position as the price starts to turn. If the consensus has a certain view and the price action several days, several weeks is not confirming the consensus view, something else is going on. It's that part of the market underneath the surface that we don't see that's going on that's driving the price action. But you will be quick to move because you'll have a alternative scenario based on solid rationales to move quickly and start to position ahead of the consensus that gets stuck in their view and says, I'm right, and fights it, and all of a sudden there's a capitulation, whew, and then you see those big spikes when everybody capitulates, and that's how that happens. People tend not to develop alternative rationales. They stay closed. They stay arrogant. They're not objective, and all of a sudden they realize they're wrong. People tend to realize that at the same time based on key events, and then you see those capitulations and those big price moves. If you're there already, even within a portion of your trade, that's where you're going to make the money. And as I said, I think the option's a great product to do that with. Our current dollar scenarios, again, these are intermediate dollar scenarios, 3 to 6 month time frame. We have our most confident scenario, and it just so happens our most confident scenario is a little bit out of the consensus view. And then we have an alternative, all alternative scenario is really more the consensus view, so this is slightly turned around. But our most confident view right here, and we are positioned for it, for better or for worse, is the dollar moves higher in the near future and gets another major risk bid. And I'll explain that. Our alternative view is kind of what the consensus is now, that the U.S. is going to continue to muddle through, but the U.S. is going to continue to be the stimulator of last resort. We're going to try and move into a weak implicit dollar policy, which really was the driver of the dollar lower in that bear market that started in 2002 to 2007. It was very much an implicit weak dollar policy that benefited the U.S., at least from the policymaker's standpoint, and I'll explain that. But this, I think, is what the consensus is. But right now there's a battle going on. If you've watched what the U.S. dollar index has done over about the last 25 days, this. There's a battle going on. There's a real battle, and it's between these two concepts. Unfortunately, we never know which side is going to break out, but we do know this in terms of, or at least we think this based on our technical analysis. Usually the longer something moves sideways in a range, the more powerful it builds, the more power it builds. So once it breaks out, it tends to be a very powerful move one way or another. So right now, we're playing for this, and I'll explain to you why. Before I do that, let me again show you where the dollar index is. Here's that consolidation really on a weekly basis. It's not as apparent, but a lot of sideways movement lately. Here's where the dollar has been. We've come down from, this is 2004, but 2002 it started, came down. We bottomed right here in March of 2008. The day they say Bear Stearns actually was the day the U.S. dollar bottomed. Also happened to be the exact day that gold topped. It was the day of the dollar bottom for those of you that watch gold. Bounced around, and again, in our global macro analysis and our simple overlay analysis, I don't have it here. I apologize, I should. But in this time frame between March and July, this is when the dollar started to rocket again in July. Let me clear this off. I'm sorry. This is another global macro view that really helped us in a very, very big way. Again, you're doing your global macro analysis, and remember that chart I showed you before. You're watching how hot oil is. Think of oil as this blue line, which is a big part of the commodities index. As oil going up, dollars going down in lockstep. Okay? But what happened was, as the dollar bottomed here in March when they say Bear Stearns, oil actually went up. Say this was oil. Oil actually went up like about another 40% in price. It went from $104 to $103 or $104 to $147. But all of a sudden the dollar, look at what the dollar did. It went sideways and actually went up about 2%. As oil was making its peak, the dollar went sideways. Well, again, something changed here. It was going in lockstep. Down, down, down. Oil blowing off to a high, you would think the dollar would have just blown through. That in and of itself was an alert that something changed in the global capital flow. Something changed underlying this market, underneath the surface, in a very, very big way. So that alerted us to a trade and some of other analysis, as I said, on the credit crunch. But right now we're going sideways. We had a big bounce. This is that big risk bounce when the credit crunch hit. Now the dollar's come all the way back down on the green shoots. The green shoots again, moving money offshore, get out of the dollar, so the dollar's come back down. And now we're back here going sideways, and people are evaluating, are the green shoots for real? If they are, keep moving money offshore. The U.S. is going to continue to fund this global green shoot, or if they're not for real, maybe the dollar gets another major risk bid. And this is our number one scenario here, and I'll tell you right now, and we'll find out very soon if we're very, very wrong. Our risk bid is based on the fact that we think there's going to be a major disappointment in green shoots. We look at stuff in our general readings. Unemployment in the U.S. is lurching from bad to worse, and maybe unemployment in the structural shift in this economy is becoming a coincident indicator instead of a lagging indicator. So the numbers in the U.S. seem to get worse. U.S. demand has not rebounded at all. U.S. consumer is still the driver of the globe, whatever people say. If you keep that concept in mind, you'll understand what's happening in global demand. The U.S. continues to save, and the U.S. savings rate, and again, you'll get this in your reading of Global Economic Forum, is spiking from negative 2% in the midst of that cycle, and it's now probably up to 6 to 8% of GDP positive, and we think it could go to 10%. So again, this stuff says that the major demand driver in the world, his jobs are getting worse, the job outlook's getting worse, he's still saving, he's buying less. So this bodes very well for a double-dip recession, that's one way to say it, or a real disappointment in green shoots.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.